A bull market is when stock prices keep going up for a long time. A bull market usually lasts longer than a bear market and happens when prices go up by 20% or more from their lowest point. This happens because people feel very hopeful about the economy. The name bull market started in the late 1700s. People picked the bull because it attacks by moving its horns up, just like rising prices. Since then, bull market has meant a time when stock prices are going up. Beginners should learn about bull and bear markets because they are both normal parts of how the market works. These cycles have happened since the stock market began. A bull market can make a country's economy much stronger. People use the term bull market when they talk about stock prices going up. A bear market is when stock prices keep going down for a long time. A bear market can also happen when stock prices fall more than 20% from their highest point. This usually happens because people are worried about the economy slowing down. The term bear market started in the 17th century. The first time bear market was used for stocks was in a book called A Plan of the English Commerce by Daniel Defoe in 1720. People used the words bear market when stock prices drop more than 20% from their recent highs. Beginners should remember that both bull and bear markets are normal parts of how the stock market works. Bear markets have been happening since the stock market first began. It is important for everyone to know about bear markets because they affect the whole country's economy. During a bear market, investors should be careful and watch the market very closely. People often talk about a bear market when the whole stock market drops very quickly in a short time. Recession means the economy of a country is doing badly for a long time, sometimes for months or even years. A recession happens when a country's economy shrinks for 2 quarters in a row. A country is also in a recession when people want to buy less than what companies can sell. The word recession comes from the Latin word recessus, which means a going back. People first started using the word recession in the 1800s. Since then, recession has meant a time when a country's economy goes down. Every beginner should know what a recession is because it affects the whole country's economy. This word is important for investors because a recession can hurt their investments. The word recession is used a lot in financial news and reports. Inflation happens when the prices of things people buy keep going up for a long time. Inflation makes money worth less over time. For example, someone with $1,000 could buy a lot more things 20 years ago than they can today. The word inflation comes from the Latin word inflare, which means to blow up. People first used the word inflation in 1838 to talk about having more money in the economy. Now, inflation means prices for goods and services are rising. Beginners should learn about inflation and invest some of their money so it doesn't lose value. This word is important for investors because it helps them pick investments that grow faster than inflation. Inflation is a very common word and is used by analysts, economists, and investors all the time. Market volatility means that stock prices go up and down a lot, sometimes very quickly. Market volatility shows that the market is unstable and it can be a risky time to trade. Big changes in prices can happen because of news or special events that change how people feel about the market. No one knows exactly where the term market volatility started, but people have used it for many years. Beginners should learn about market volatility because it affects how they manage risk. Investors care a lot about volatility because it can change their investment decisions. Market volatility is a common word used by investors and financial analysts when talking about the stock market. Economic bubble is when things like stocks or houses are sold for much more than they are really worth. An economic bubble is also called a market bubble or a financial bubble. This bubble pops when prices drop quickly, which is called a market crash. The term economic bubble comes from the South Sea bubble in Britain from 1711 to 1720, when company stocks got too expensive. Since then, people use economic bubble to talk about prices going up too high because of too much demand, not real value. This term warns beginners not to buy things that are way too expensive. Knowing about economic bubbles helps investors make smart choices and avoid losing money. People use this word a lot when they think prices in the market are getting too high and a bubble might be forming.